Hello, everyone. Welcome to today's webinar. So my name is Connor Spencer. Today we're going to be discussing unlocking success, choosing the right business structure for you. Now, this is a very familiar but very important topic we routinely discuss with new and existing clients. I'd say it's comfortably a top 3 or even top 5 accounting or legal question we are asked. For those looking to start a new business for the very first time, or those who already have a business and may be seeking questions around restructuring. For those of you perhaps starting out with your new business venture, obviously getting the right legal structure in place for your business. And you can just go back, Damon, I'll get to that shortly. For your business has monumental short and long-term implications. And these implications can center around costs, around legal liabilities, and around tax benefits and concessions. So today's webinar will be joined by Damon Murdoch. He is LawPath's principal lawyer. He has been practicing for decades and has extensive experience within this field as well as other legal areas in commercial and business law. If anyone wants to view our Meet Our Lawyers page on our website, you can see our lawyers who deal with our legal advice plan clients. And you'll see, for example, Damon has a 5 out of 5 star rating out of over 300 personal reviews. So we can go to the next one now. Thank you, Damon. So today we're going to be covering different types of business structures, those being the sole trader, partnership, company, and trusts. We'll be considering the key features of each structure, different types of companies, and some preliminary considerations before starting a company. We will finish by showing you how LawPath can help. We will have a short demo of a company registration quiz to assist you in your decision making. That being said, if you want to basically guarantee you start your business off on the right foot, the gold standard will be to take the time to discuss with one of our lawyers what might be the right entity and structure for you. So just briefly, for those of you who are new to LawPath, might be visiting us for the first time, we are an Australian-based online digital legal platform. We have been operating for 10 years and helped over 500,000 small to medium businesses in different capacities within that time frame. We are tailor-made for startups who need the service, but obviously also need to save on legal and accounting fees. And we do this in a myriad of ways. So fundamentally, we provide on-demand legal assistance through the software and our contract management system, as well as day or next working day professional legal accounting advice through our consultations portal. For the individual business owners, we save thousands of dollars in legal and accounting fees. Within the last decade across Australia, we've saved small businesses over $100 million. Finally, we will conclude with a Q&A session. So it's the opportunity to submit your questions. Specifically, please do that in the Q&A chat box. It's a separate box from the general chat one. So put your questions in there and Damon will address them at the end. But that's enough from me. I'll hand things over to Damon.
Thank you very much, Connor. Welcome, everybody. So today we're talking about business structures. We're going to start off very basic, just from sole traders, and then we're going to get more involved into trust structures and dual company structures, and we'll get into tax as well. So if you are a little bit more sophisticated in how companies work, you can maybe fall asleep a little bit for the first 5 minutes, and then we'll start ramping it up, getting in more complex stuff. So let's begin. Now, another thing is, if you have any questions, pop them in the Q&A, whether they touch upon this presentation or anything, I'm happy to answer anything. So we always find the Q&A is the most valuable time for people to ask their specific questions. So feel free to pop them in as we go. So the general different structures that we normally see that are most common is a sole trader or a partnership or a company. And then we get into dual company structures, family trusts, and things like that, which we'll touch upon separately. So the first thing is a sole trader. A lot of times people might start their business and maybe they're just starting off small. They have a small landscaping business. They're doing car washing, whatever it is. Maybe it's a small consulting firm. And at the moment, they don't know how successful they'll be. They don't intend on having any employees. And a sole trader structure is really easy to create. It's really easy to start. There's no areas of law really that you need to know about other than your accounting side of things. But when it comes to company structures and the Corporations Act and director duties, you don't need to worry about that. So all you effectively need to start running your own business is getting an ABN. So really easy to operate, really easy to create. And so the cost savings at the beginning is good. But the benefits that you get from a company we'll talk about later. And you can always switch from a sole trader into a company as you grow. And if you have any questions about how to do that, happy to answer it if I don't cover it in this presentation. Now, the next one is we look at partnerships. Now, partnerships is kind of old school in many respects. A lot of times, some of the older accountants will still create partnerships. They used to really be made for law firms and accounting practices and consulting businesses. And that was because the law didn't allow lawyers to have a company. Lawyers had to operate under a partnership, and same thing as accountants. But they changed the law many years ago to enable us now to have incorporated legal practices and accounting firms. And so the partnership law is kind of dying out. It's not that common anymore. But generally, if you look at the differences of what a partnership and a sole trader, they're actually quite similar. It's a sole trader, you're acting on your own. You might get a business name so that you can have a name to present yourself as a business, and you have an ABN to issue invoices. Whereas a partnership is almost like a combined sole traders, several sole traders coming together. They might share one bank account and one business name, but in effect, from a tax perspective, all the profits that are being derived from that business are going back to you individually, and you're paying your normal income tax on the profits that you derive from your business. Again, the advantage from a partnership can be from a tax perspective because it just goes into your own personal tax. But the main disadvantage is that you don't get the advantages that you would otherwise get from companies. And that's like deferring your tax, holding your profits without having to distribute it to yourself. So you don't have to actually pay the income tax right away. And then some of the other disadvantages with the partnership is the legislation or the law is old. I think in New South Wales, the Partnerships Act is 1979. And I think other states it might even be older than that. And there's not a lot of case law that's developed. It's basically, if you ever have a dispute with somebody, it comes down normally to a contract dispute. Whereas under the Corporations Act, it is a very, very robust legislation that deals with almost everything. And there's so many cases on this area of law that everything's fairly clearly defined and every situation is already been dealt with. So you kind of have a lot of guidance on what to do when there's a dispute, for instance. Now, with a company, with a sole trader and with a partnership, if you get sued, you're personally liable. So you are the one that is operating the business, you're responsible. Whereas with a company, the company is a separate legal entity, which means that it acts in its own capacity. So if anything happened with your company, like the company was sued, normally you as a director of the company or you as a shareholder of the company aren't going to get pulled into those legal proceedings because the customer will only have a dispute with the company itself. Now, there are certain circumstances where they can bring a director in, which I'll talk about separately, but the main benefit for a company is it's a separate legal entity and it gives you some asset protection because your personal assets aren't on the line. And it's instead the assets of the company that's on the line if something goes wrong. So the way you incorporate a company, you can use the LawPath platform, but in essence, you go to ASIC, which is the Australian Securities Investment Commission. You register a company has shareholders who effectively control the business, and they have the right to appoint a director. So normally 51% of the shareholders who hold the shares have a right to appoint or remove a director, and then you normally create the company possibly with you as a shareholder, and then you as the shareholder appoint yourself as the director. And the director is the person that does the day-to-day management of the business, signs all the documents, files all the tax returns, negotiates everything, you name it. It is essentially the sole trader, but it's in a capacity as a director, not in a capacity as the business. So that's the benefit of having a company, is that it's that separate legal entity. And so when you look at the liability of the shareholders, the people that own that business, they're limited in liability to the amount that they've paid up on their shares. So if you incorporate a company with 1 million shares for $1 each, it means that that shareholder is liable for $1 million unless they've paid that $1 million to the company. However, if you created a company with 10,000 shares at 1 cent each, then the shareholders are liable for $100. And that's it. And no one can go after the shareholders for anything more than those $100. And once they pay that $100 to the company, that's the total liability of a shareholder. Now, if you look at the liability of the directors aren't generally liable for anything. It's the company that's liable. However, there are certain circumstances where a director can be found to be personally liable. So that's insolvent trading. And insolvent trading occurs where a company incurs debts when they cannot pay those debts as they come due. So, for instance, if you borrow money from someone, but you know you can never pay that money back, and the company goes and enters into an agreement saying, "Sure, I'll pay you back the 100,000," but you have no revenue and you actually have no way to pay that money back, then just by signing that loan agreement is a real possibility that you as a director have committed an act of insolvency. And then if you continue on trading and you're not paying any interest on that loan and you continue on incurring more debts, your insolvent trading and all those new debts that you're incurring, you can be personally liable for because you're trading insolvent. Another thing is, as a company, you have to withhold your tax when you have employees, for instance. So you have to withhold their tax before you pay them their final salary each month or each fortnight. And you have to withhold that, and you got to withhold your GST. So when you have GST, you collect GST for all the sales that you make, and you pay out GST for all the expenses that you make. And then the balance that's left over, you got to pay that to the ATO. And if you don't pay, and that's by doing your business activity statements normally every quarter. Now, if you don't withhold the tax for your employees and you don't pay your GST to the ATO, or if you don't pay your corporate tax to the ATO, or you don't pay your staff superannuation, you can be personally liable. And in those circumstances, the ATO will see that the company has all these corporate tax debts, and they can find the director personally liable by issuing what's called a director's penalty notice on the director, and then they transfer those debts to the director personally. One other area that normally a director can be personally liable is misleading and deceptive conduct. So if I told you that I've been, whatever it is, and that ends up being false and misleading, and you rely upon that, and you end up entering into a contract with the company, and it's found that everything that I said to you is false, then you could sue that director and the company for misleading and deceptive conduct. But other than that, those are generally the limitations to when a director can be personally liable. Now, shareholders can sue directors, and other directors can sue directors for breach of director duties. And your director duties are generally to use due care and skill and reasonable judgment when you're operating your business, not to misuse the company information for your own benefit or someone else, not to misuse company documents for the benefit of someone else. And in those circumstances, so if, for instance, if you were running a company and you wanted to start up a competitive business, and just before you quit this company as a director, you go and steal all the information and all the intellectual property, and you go start your other competitive business, then you resign from this business, then this business can sue you for breach of director duties, amongst other things, probably breach of restraint clause, infringement of copyright, infringement of intellectual property, things like that. But at the end of the day, if you have a company It's a company that's entering into the contract with the customers. It has a separate, it's liable in its own right. Now, in terms of tax, the benefit there as well is that the company gets taxed at its rate, which is a lot lower than your income than your income tax rate. So rather than the company paying the money and distributing dividends to you as the shareholder or paying you income, the company can potentially just hold on to those profits and reinvest those profits back into the company. And then you end up saving tax by distributing the money to you as a shareholder or a director. And then you then lending money back to the company. You're now paying tax on your income because you personally received some of the profit, and then you're putting the money back into the company, and then you're paying capital gains tax on the interest that you're earning, and it all becomes very complicated from a tax perspective if you're paying yourself out the money and then putting the money back into your company. But if you are planning on growing your company, you just leave the money in the company, don't pay yourself necessarily, but you can get your mobile phone paid for, you can get your internet paid for, you might be able to get your car paid for, and a lot of things the company can pay for because those expenses are expenses of the company that you are going to be benefiting from. So there's a lot of ways to reduce your tax, increase your expenditure to reduce the tax when you has a company. So you have the asset protection side of things, you have the tax side of things that are a benefit as well. The other thing about the benefit of a company is it helps you grow. And when I talk about helping you grow, you can bring in shareholders, so you can sell shares and have people buy into your business. You can create employee share schemes, so you can give your employees options to convert into shares later to be able to keep them potentially. And you also can benefit from different government grants that don't exist for sole traders. A lot of the government grants require you to have a company. And one of those grants are really important to know about is called the R&D tax incentive. And the R&D tax incentive is essentially saying for any new research and development that you're doing that's innovative, that you're able to commercialize, and that's owned by your company, you can make an application to the ATO to get 43.5 cents back on every dollar that you've spent on research and development. So if you are building software right now in your basement or in your house, and you think, oh, I'm going to create a company later, and then I'm going to then launch my business after I've developed this software, that's probably the wrong approach. You actually want to incorporate your company now, record all your time, all the money that you're spending on whatever it is to develop that. It's all being put through the company so that then you can make an application and get 43.5 cents back on all the R&D that you're doing. Now, as a lawyer, we don't do those R&D tax applications. It's normally an accountant. So if you do have any questions about it, you can Google R&D tax incentive, or you can sign up to what's called the Legal Advice and Accounting Plan, the LAP plan through LawPath, and that has a plan where you can talk to an accountant on any new legal issue or any new accounting issues. So if you wanted questions about that, you could ask them as well. Now, trusts get a little bit more complicated. Trusts normally are used when we create up a more sophisticated structure. And I'll explain it kind of practically how it works, because talking from a legal perspective how it works gets a little bit complicated. But a trust, you can almost consider it as a contract. And that contract has four parties. It has what's called the appointer, and that's the person that appoints the trustee to manage the trust. And then you have the trustee that does the management. It's kind of like a director of the company. They sign documents, they do the tax returns, things like that. And then you have the beneficiaries, who are normally your parents, your siblings, your spouse, your children. And these are the people that can benefit from your trust eventually. And then you have the settler, the person that creates the trust on your behalf. Normally, it's your accountant or your lawyer. And so the way that a trust works is normally the trust is created, and it becomes, or the trustee of the trust becomes the shareholder of your company that's trading. And so then what happens is that when the company is trading and makes a profit, so for instance, the company makes $100,000 profit after it's paid out expenses and receives its income, it then pays about 25% tax on that 100,000. So now you get $75,000 left over. Now, with that $75,000 left over, you can invest some of it back into the business to buy some assets for the company, things like that. Or you can distribute that $75,000 to the shareholders as dividends. Or you can pay the director a fee, like an income, but you can pay the director a fee as well. But if you take that profit and you pay it as dividends to the shareholders, that's called a franked dividend. And what that means is that there was $100,000 profit, 25% tax has already been paid on that. So now, when you're paying the remaining $75,000 to the shareholders, they have to pay the difference between their tax bracket and the 25,000. So, for instance, if you were the shareholder and you were in a 30% tax bracket and the company paid 5% tax or 25% tax on the 100,000, the company then distributes the 75,000 to you, and you have to pay 5% tax on that because your tax bracket's 5% higher than the company's. But if you distribute it to a trust where the trust is a shareholder, you don't have to distribute it all to you. It then goes to the trust, and the trust can then distribute some money to your children, some to your spouse who might not be working, some to you, and distributes that 75,000 between the different parties. So, and they might decide, for instance, to give $25,000 to you, but if you haven't earned any other income that year, then you're probably still on a very low income. And your tax bracket might still be at around the 25% mark. And the same thing with your spouse. You can transfer 25% or 25,000 to your spouse. And so what this does is it does income splitting so that everybody's income in your family can be reduced down. So you're not going above into a higher tax bracket like the $40,000 tax bracket. The other benefit is that by having it in a trust, those are trust assets. So if the trust buys assets, then what happens is that that's protected. It's owned by the trust. It's not owned by you. It's not owned by the beneficiaries. It's not owned by the appointer or the trustee. So if you ended up getting sued for whatever reason, the trust assets are protected. So it gives another level of asset protection, but it gives another level for mostly for income splitting. And you can have different kind of trusts. You can have a discretionary trust, which means the trustee gets to choose which beneficiary gets the distribution or how many of them gets the distribution from the profits of your company. Or you can have a fixed unit trust where everybody gets a fixed equal amount. Again, it does get a little bit complicated explaining it verbally, but if you have any questions, just pop them in the Q&A. Now, when we look at these company structures, a lot of times people create what's called a dual trust structure. And this is where it gets even more complicated because what you have is maybe you have your family trust, and then you have that owns shares in a holding company. And then that holding company then owns all the shares in the trading company. And then the trading company does business with the customers. And the reason why people create that structure is again, it's a level of asset protection. So what happens is that, let's say you're building software or you're buying equipment, you build all the software and you own all the equipment in the holding company. So the asset is actually owned by the holding company. And then the holding company then licenses it down to the trading company to use. And then the trading company then uses it by way of the license. But if the trading company ever got sued, the holding company can come in and claw back all those assets and leave the trading company as an empty shell with nothing left. So for instance, you would maybe put your trademark, your domain name, your software, your factory, your equipment, everything into your holding company, license it down to your trading company. And if something ever happened to your trading company, you could put it into liquidation, but all of those assets are clawed back into the holding company, and the holding company can potentially just create another new company and begin trading again. So those are the benefits of having what's called a dual corporate structure to give that another level of asset protection in the event your company is potentially doing something that could be risky. Now, the other benefit, the other thing that you need to consider is insurance, which I'll talk about in a moment. So how are each of these different ones taxed? Sole trader, you get taxed at your normal tax rate. You normally can't offset your losses from other income. You normally can't defer your tax or pass on capital losses or gains between different years. Whereas with a company, you're normally taxed at around the 25% mark. You can, if you have losses from one year, you can take those losses and apply them to your next year to offset your profits from the next 3 years, I believe. So that gives you a benefit so if you're trading without a profit for the first couple of years, you take those losses and you apply them to the years where you do have a profit, and that reduces your tax. Partnership is the same as sole trader. It goes back to your normal tax rate. And then trusts, the trust normally doesn't get taxed. It's the beneficiaries who actually gets paid out the dividends or the distribution from that trust that gets taxed at the normal tax rate after they're normally receiving the franked dividend from the company. And so what that does is then you have that trust and you can distribute it amongst different people, so you can do income splitting, keeping yourselves all below the high income thresholds where you're paying a higher tax rate. Now, I mentioned about the personal exposure. You don't really have any asset protection as a sole trader. The only protection you might have is insurance from a company. You as a shareholder, you're not liable. As a director, you have only very limited circumstances where you can be personally liable. Partnership, same thing as a sole trader. And a trust, it normally doesn't actually trade, so it normally doesn't really have any liability. And if you have what's called a trading trust, we generally don't recommend it at all. And a trading trust is where you create a trust, and then the trustee is the one that actually enters into contracts with the customers. Sometimes accountants create it that way, but it actually doesn't give any asset protection at all. So we don't recommend that. But that's generally the different structures that we see quite regularly. Now, which one do you choose? That is a very difficult question because it really depends on how much money do you have, what kind of business are you running, what's your future for your business? Do you plan on bringing in investors? Do you plan on bringing in other shareholders? Do you plan on hiring staff? Do you plan on buying assets? Is your business a risky business? Are you doing R&D where you're doing research and development, which would benefit from that? Are you doing something in a sector that might be able to get government grants, which you would be able to benefit from that if you're a company? So that's generally what we look at: your risk, your tax, your costs, and then determine what structure is best for you. Now, LawPath has generated a quiz for you to decide which structure is best for you. Obviously, it's not tax advice and it's not legal advice, but it's going to give you a pretty good indication of which structure is generally the most appropriate one for you. So if you want to do that quiz, if you just pop into the chat yes right now, then someone from LawPath will contact you and show you how to perform that quiz. And the same thing with if you are looking to sign up to LawPath or you have any questions about it, just put yes into the chat and Connor will call you after this presentation. He'll contact you and talk to you about everything as well. Now, considering other things about your business, so if you are going to create a company, normally you need to have someone who's ordinarily residing in Australia. But you can have a foreigner who is also a director, but you have to have at least one someone in Australia to be a local director for you. For shareholders, you can have as many as you want, but if you do have a shareholder, more than one shareholder, you normally want to get a shareholders agreement, which is really important. Now, we have a YouTube channel that you can subscribe to, and on that YouTube channel, there's all our past webinars are there. There's a bunch of videos that are done. They're about 5 minutes long, explaining what's a shareholders agreement, what's a license agreement, what kind of corporate structure, how do you do capital raising. things like that, what's preference shares, what's founders' rights. So feel free to go to the YouTube channel, look at the videos there as well. Some other things to look at is getting a trademark. So just because you registered a company that you're really happy with doesn't mean that your brand is protected. Just because you got a business name doesn't mean your brand's protected. So if you don't want someone else from trading under the exact business name that you have, or at all in your industry, then you want to get a trademark. So a business name and a company, all that does is stop someone else from creating the exact same name. So for instance, we have LawPath Operations, we have LawPath Legal. Now, if LawPath doesn't have a trademark, then you could create a company called LawPath Services or LawPath Holdings or law whatever it is. So you can just add on another word, and LawPath can't stop you from doing that. But if LawPath has a trademark and you did it, then you would be stopped from doing it in technology services. You would be stopped from using the word LawPath in the legal industry and so on. So that's what a trademark does. It actually stops people in your industry from being able to use your brand. And then the other really important thing is that it also stops someone in the future from coming up with your name and then getting a trademark after you. And then once they get their trademark, telling you to stop using the name that you've been using for years. And then finally, if you are going to create a unique name for your business, go to the IP Australia website and do a trademark search and make sure no one else has that name already trademarked, because you don't want to launch your business, spend money on branding, spend money on advertising, and then find out that someone else already has the trademark and is going to stop you and make you change your name in a couple months. Another thing to look at is employees versus contractors. When you hire an employee, anything that they do for your business is owned by you. So if any kind of intellectual property that they create is owned by your company. But if you hire a contractor, that information is not owned by your company. It's owned by the contractor. And the only way for you to actually own what that contractor does is to have a contractor's agreement that says the intellectual property that they've created has been assigned to you. So if you hired someone to do a website for you and make a website, that person owns that website, you don't. If you hired someone to make a logo for you and you don't have a contract, they probably own that logo. So you need to have a contractor's agreement for anyone that's not an employee that's doing something in your business to make sure you own your intellectual property. Now, if you forgot to have a contract, you can use what's called an IP assignment deed. And that basically is a backward looking document saying, look, I know you made a logo for me. I need to make sure that I own it because I'm going to have investors one day. I don't think we had a contract. Can you sign this IP assignment deed just confirming that the logo is owned by us? And then that will allow for you to transfer all that intellectual property to you. And if you create your dual structure and you have this license between the two entities, like the holding company and the trading entity, you need to make sure you have a written license agreement, and you've got to register what's called a PPSR. So a PPSR is a personal property registration. It's a security interest under the Personal Property Securities Act. And by way of analogy, is if you bought a car, you got finance on your car, your financier takes a charge against your vehicle. And so then if you go and try to sell your vehicle, a new buyer can see that that financier owns it. And that financier has the first right to repossess that vehicle, even if it's sold. It has the first right to repossess that vehicle and to take ownership of it if it needs to. Now, what happens is that if you have a holding company and that holding company licenses the technology and the domain name and the trademark to your trading company to use, and you register a PPSR, a security interest against your trading company, if your trading company goes into liquidation, what happens is that the liquidator is appointed and can see all the assets that the trading company has. But what will happen is that when it does that, if you've registered a PPSR, it means that the liquidator will see that the holding company actually owns it and will transfer everything back to your company, and you will have the powers under the PPSR to be the first registered secured creditor over your trading company. So it's important not just to have a license, but to also have a registration showing your secured interest against your trading company. If you're going to need to look and see whether you have any permits as well. So if you need a liquor license, a food handling license, a labor hire license, building license, so on. If you're in New South Wales, you can have a look at this website. I think this website actually is nationwide. So make sure you're not trading without a license. If you generally trade without a license, you're normally committing a criminal act. So you got to be very careful of that. And then in terms of insurance, if you are a personal trainer and you're taking control of an environment, like you're in a park and you're holding a personal training session, then you're in control of that environment. You need to have public liability insurance. That's your slip and fall insurance. If you have an office where someone was going to enter, and you're in control of that office, you need public liability insurance for slip and fall. Now, if you are providing a service, you should have professional indemnity insurance. If you're selling a product, you should have product liability insurance. If you have employees, you have to have workers' compensation insurance. And sometimes people have director and officer insurance to help you in the situation where you might be insolvent trading or misleading deceptive conduct, things like that. D&O insurance might pop in. There's also cybersecurity insurance, which is very expensive and very hard to get, which helps from data breaches and things like that. So those are just a touch upon a couple things in terms of insurance. And then finally, just touching upon shareholders agreements. When you have a company, the Corporations Act applies. And when the Corporations Act applies, it means it's a federal law that only normally the Supreme Court of your state is able to deal with. So if you have other shareholders or directors or investors and there's a dispute, normally the Corporations Act will come into play. And that means normally if there was a dispute and you can't resolve it, you got to go to the Supreme Court to resolve it. And the minute I mention the Supreme Court, it's around $3,000 filing fees. You normally need a solicitor. You normally need a barrister. The minimum costs are generally around 25 grand. But with the shareholders agreement, it normally has a dispute resolution clause, which effectively says, well, if you are going to go to court and you are going to fight it, then you can only go to court after we've locked ourselves in a room for 8 hours with a third party mediator who's normally a former judge or lawyer, and they are trying to negotiate a deal with you for 8 hours. And generally, by being locked in a room for 8 hours to do a mediation, you normally get results. So without a shareholders agreement, you don't have that provision, and there's no need for anyone to talk to you. And the only way to get a resolution is really going to the court. Drag along rights is really important. I use this as an analogy. In the Gold Coast, there was an apartment building they wanted to sell to a developer. All the unit holders, all the apartment owners agreed to sell all the units, but one apartment holder refused to sell. And that meant that either the developer was going to have to effectively bribe that one person to try to get the deal done by paying them a lot more than everybody else, or the deal was going to just fall through completely and everybody else was going to lose. And a drag along clause effectively prevents this. It says normally if 75% of the shareholders all agree to sell the business, you can force the other 25% to also sell their shares, forcing the sale of the 100% of the business. Shareholders agreement also deals with vesting conditions. So if you start your company with 3 people and they're all supposed to be working in the business, then you can tie them down for maybe 3 years saying, even though we're giving you 33% of the business, you have to earn the shares and you have to work in the business for the next 36 months. And every month you work in your business, you earn 1 divided by 36 month on month. And by the end of the 3 years, you've earned all your shares. But if you quit after 12 months, you only keep 12 over 36 of your shares, like 1/3 of your shares, and we can take back the other 66% that you never earned. And that's really important when you're giving shares to somebody on the presumption that they're going to be working in the business. So that's all I have for now. So pop your questions into the Q&A, and we will now jump over to Connor to tell you a little bit about LawPath, and then we'll be back in a moment.
Awesome. So thank you, Damon, for that comprehensive presentation. So I just want to cover off again how LawPath can help before we jump into Q&A. So we can supply your business with unlimited legal documentation, and through our contract management system, you can complete professionally drafted templates by our lawyers within 5 to 20 minutes. We also have a series of workflows. These are 9 popular tasks with businesses regardless of industry, and these include setting up an NDA, setting up a trust, dismissing an employee, hiring an employee, hiring a contractor, setting up a website, collecting a debt, and onboarding a new client. Now, you can also book legal consultations with our multidisciplined senior lawyers through the platform, for which we provide the same day or next working day consultations. Again, if you'd like to discuss this further, please type yes into the chat. So you should be able to see on screen our tax deductible subscriptions. You can see, for example, our Starter Essentials package, which includes our fully customizable 500 legal templates, and our documents have an e-sign capability, meaning you can send your documents and contracts digitally to your employees or clients or suppliers, and they can sign from their own devices. This also includes all the features of our AI, which uses multiple language models, and you can ask it legal questions. It can draft additional clauses for your document, and it can review your document and provide further key insights. It has a simplify mode. So if you're like me and have no formal legal background, you know, maybe you're looking at these contracts and there's specific legal jargon, you may not be 100% sure on what it means. You can highlight that text, and the AI will essentially re-explain it in a separate window in layman's terms. That being said, if you are about to sign a contract potentially worth thousands of dollars, and there are things you're not sure of or want reviewed, there's literally no downsides to speaking to a human. By that I mean speaking to a legal expert. And finally, there is a translation feature there as well, so you can change the text to 31 different languages. Down the middle, we have our most popular legal advice package, which includes everything within our essentials, but obviously with the added benefit of unlimited legal consultations and unlimited on-call contract reviews, including any external documents you may have yourself. It's also connected to our legal team via our quick chat box. So maybe you're on the go, you don't have time, or you just have a simple question for us. You can pop it in the live chat and get a quick answer back. And we cover, but not limited to, obviously, business structuring, business purchase and sale, contracts you will need for your business, intellectual property and trademarking. We cover employment and HR, debt recovery, ESOP and startup law, as well as commercial property law. So our most comprehensive package on the end is our legal and accounting advice. You can get unlimited consultations with our award-winning chartered accountants, and a lot of our clients on that subscription are provided with year-round advice on tax minimization, deductibles, tax concessions, business structuring advice from the accountant's perspective, superannuation, reporting, payroll, and bookkeeping, as well as a whole host of other tax and accounting related questions. And having this know-how can obviously support and save your business hundreds of dollars. We also have an add-on option to get your hands-on tax needs met. So you can never obviously fail to lodge a BAS or tax return. And obviously when doing so, it's done accurately. And we have a compliance package there where you can have your BAS lodgements, tax lodgements, financial statements, and there's a special fiscal year consultation to do a deeper dive analysis of your business spending and revenue. Not advertised on here, we also have an asset compliance plan where you're paired with our business services team who can make year-round changes to your company to avoid late change fees. And our asset agent will keep your company up to date with things such as an office address or directorship or shareholding type. And for those of you without a commercial address and might be using your home address, we also offer a virtual office service where LawPath can be your registered commercial address. It adds a level of commerciality and credibility to your business. For the benefit of privacy, so then people searching your business will no longer be able to see your home address, and any mail from ASIC, ATO, or clients will be sent to us. We physically store this, but then we upload it digitally onto your LawPath account. So finally, for our attendees today, we do have a special 25% off on our legal advice plan. You'll have immediate access to our templates. You'll be able to book a discovery call with one of our lawyers for tomorrow. And this is an opportunity to basically outline your business with any short and long-term goals, discuss any pressing legal issues you're faced with, but most importantly, maybe explore any legal gaps in your business you are not aware of, as you don't know what you don't know. Again, if that's of interest to anyone, if you have any further questions with that, please reply yes in the chat and someone will reach out to discuss further. We can even run a quick demo of the platform so that you can see it from the subscriber's perspective.